Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
So yeah, I took a little longer break than most people do for Thanksgiving, but it was needed. It was needed. But we are back, so welcome everyone to the Monday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the stories that are moving rates every single day, weekday, in 15 minutes or less. And the good news for Monday is that we really had no stories. Nothing was happening, no economic data, nothing that moved rates, which is why rates didn't move that much. They continued kind of their upward climb, up about 2 or 3 basis points. So because of that, we haven't done a show for a while. So let's talk about what happened on Friday, because I think that's sort of impacting what is happening. It happened on Friday and, of course, on Monday. And that would be some of the economic data that is showing some positive movement in the economy. It's been a lot of negative data for like a month or so as the government's reopened and we're getting some data. But we actually got some good news on Friday, which sometimes can translate into higher rates, oddly enough. So we have mortgage rates, mortgage bond yields are up about 16 basis points over the past week, which is kind of surprising considering we're going into a Fed meeting, which starts Tuesday, and then we'll have the announcement on Wednesday. And from pretty much all I can see, the CME Fed Watch tool has the chance of a rate cut on Wednesday at 89%. So we're going into a Fed meeting where the Fed's supposed to cut rates, and rates are rising. And we're going to get into that a little bit more detail in a little bit. So it is a little surprising there. So why have we seen rates rise? Well, like I said, we got some kind of conflicting data on Friday. So we got some good news for rates, which was inflation data. So we got consumer prices rising 0.3% in September, which is what economists were expecting. Year-over-year inflation also climbed to 2.8%. That was the 5th straight increase and was the highest level since April. I know what you're thinking, Tyler, that's not good data. Why did you say it? Well, it's because core inflation is really what the Fed is focused on, mostly because of the impact that food and energy prices have on overall inflation. Those are so kind of volatile based on a lot of different factors that core inflation is really what the Fed watches. And the core reading was a little better. Core prices were up 0.2%, and annual core inflation actually fell to 2.8%. It was the first decline in 4 months and the lowest level since May. So that was the good news. Also in the report, personal income increased 0.4% in September, exactly as expected, but spending did slow 0.3%. That was the weakest pace in 4 months. And so the downshift reflects how even cooling inflation is continuing to weigh on household budgets, because just because prices aren't rising by as much as they were, they're still rising. And it's clearly having an impact on consumers. However, we got our preliminary look at the University of Michigan's consumer survey looking at consumer sentiment, and that did rise to 53.3, up from 51 in November. And that was the first time that we had seen an uptick since July. So it's been kind of a rough year, the second part of the year with regards to consumer sentiment. November's level was, of course, the lowest level since June 2022. And so even though we did see a slight uptick, it's important to put it into context, which is we're still at the pretty close to the lowest level in 3 years. So consumers are feeling a little bit better, but overall they're still not feeling that great. And so we're in this place where we are seeing some beneficial inflation data, which would be good for rates. But the fact that we're still seeing inflation at the upper edge, almost at that 3% level, that's a problem. Now, there's been a lot of talk about could 3% be the new 2%? Could that be the Fed's target rate now? Maybe, but we haven't seen any announcement of a policy change. So being at almost 3% when we're supposed to be at 2% is not good. So that's already going to be weighing on the Fed. Then we got consumer sentiment somewhat rising. And so you can see how or why we have seen rates rise a little bit, even as we're going into a Fed meeting where a cut is supposed to be happening. But remember, and I've said this many times here, rate cuts are already priced into the market. And so if you remember back when they did their first rate cut in September, they had priced in 3 rate cuts. We saw this big drop in rates because the market was pricing in 3 rate cuts. And so this December cut is already in there. And we saw that with a kind of jump when it looked like we weren't going to be getting a December rate cut. Now that we are getting one, the market's kind of readjusting to that. But here's what's interesting from my perspective. And that is the way the market is reacting going into a Fed meeting. So we talked about the fact that rates are actually rising going into a Fed meeting. Let's look back at the last 2 meetings, because this meeting is similar to the last 2 in that we knew that we were going to be seeing a rate cut. And so how was the market reacting going into September and going into October? So going into September's meeting, between September 9th and September 16th, the yield on the 10-year fell 25 basis points. That's a pretty big drop. 25 basis points going in to the September meeting. And if you want to see these charts, I have them. They're in the newsletter that I send out every afternoon. You can go to wilmingtonmortgage.substack.com or wilmington-mortgage.com. You can find it on there as well. Between October 9th and October 29th, so a little bit wider of a window, almost 3 weeks, we saw rates fall 15 basis points going into a meeting. So we got September, 25 basis points, October, 15 basis points. And now here we are going into a December meeting, and going back about 2 weeks, November 24th, the yield on the 10-year has risen 13 basis points. So it really highlights how much different the market is approaching this meeting versus the last 2. And a lot of it is because of the uncertainty of what is going to be happening after this rate cut. We don't know. I mean, this Fed, from all accounts, appears to be one of the most divided, probably since the Volcker era. So we're talking 70s, 80s. So it's been a while since we've seen a Fed really kind of in disagreement. And so the fact that we know that we're going to be getting a rate cut, but yet the last 2 meetings we saw a dip. And then, of course, what's interesting about those meetings is that in the 2 weeks following the September and October meetings, we saw rates rise about 16 basis points. So the October meeting, it erased the gains that we saw going into the meeting. And then in September, we saw a pretty big drop or kind of canceling out the big drop that we saw going into the meeting. So what do you think? You think rates are now going to fall on the other side of the December meeting? I don't think they are. But it is very interesting because of the way the market is reacting to this meeting versus the other 2 when we knew a rate cut was coming. And it really is that uncertainty for 26. And not only do we have uncertainty, so we have the Fed divided on what is a bigger issue, the labor market or inflation. We're also going to be seeing a changing of the guard in that Powell is going to be done in May. And once again, by all reports, it looks like Kevin Hassett is going to be appointed to that position. And sort of what impact is that going to have on the Fed? And then, of course, the way the markets react to that. And so I think it's an uncertainty just in general about the overall economy and just not knowing what actually is the bigger issue. Is it the labor market? Are we seeing a stalled labor market, or are we going to start seeing a declining labor market, or is inflation the bigger issue? Have we still not gotten over that barrel? And that's why we're stuck at that inflated rate. And so it's that uncertainty, then the uncertainty of what's going to be happening with a new Fed chair. And even though we may know who it likely is going to be, what are his policies going to be? Because I'll be honest, I mean, so, Stephen Mirren was really Trump's kind of first pick to be on the Fed in, Trump's second term. And he has been, I would argue, arguing for a 50 basis point each meeting. I knew he was going to be a little bit more aggressive, but, 50 basis points. And so if Kevin Hassett is also that same level of aggressive, what's that going to do to the dynamic of the board? Because that's the sort of funny thing that everyone is realizing, and I'm assuming that's, someone like Scott Bessent, who's advising the president on these issues, pointed out that you can get rid of Jerome Powell tomorrow. The board is still divided on these issues. It's not Powell that's causing this reluctance to support a cut. It's the people who are worried about inflation. And maybe there's a political component there. There might be. But it's more than just Powell. I mean, you have the entire Federal Open Market Committee is making this decision. And you can tell from the speeches, from the comments, from what we have seen and reporting, that there is a divide there. And so, we're going into this meeting. It starts tomorrow. And then, of course, we get the announcement on Wednesday, and then Powell's press conference. And for the first time in the last 3 meetings where we're going into it, we knew we were going to cut, we are seeing bond yields rise. So I don't know. I don't think we're going to see the opposite happen, where the rates falling going into the meeting and then rates rising. So now we're going to see a reversal of that. I don't think that's going to be happening. I think the uncertainty is causing investors to say, you know what, we're just going to sell these bonds. We don't know what's going to be happening, which is pushing yields up. I don't see that changing unless Powell says something to kind of calm everyone down. So, as usual, all eyes are going to be on Jerome Powell on Wednesday. Now, tomorrow we are going to be getting some data that we'll be able to talk about. Let's see. We got job openings, some labor market data. So we'll be talking about that in tomorrow's show. And then, well, we're not going to do a show before then, but we're also getting China's inflation rate. Always important to look at. There was a great piece in the New York Times talking about China's currency and how it's just down so much compared to other currencies. You had this like $1 trillion trade surplus that China has thanks to just the absolute decimation of their dollar, or the renminbi. Yeah, that's right. Yeah, the renminbi. And then there was also a good piece in Bloomberg about the Fed's independence and sort of Kavanaugh clearly siding with the side that the Fed needs to be independent. So those are my good reads in my newsletter if you want to check it out. But all right, we're done. Closing a little early today. You guys enjoy. Hope you enjoyed your Monday. Enjoy your Tuesday. We'll be back here Tuesday afternoon for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.